Hi friends, how are y'all? I hope you're doing well. In the previous video, we learned a few concepts that are necessary for you to understand this video. Hence, if you haven't seen the first part of this video, do see it. I have shared the link in the description. In this video, we learn how to make use of those concepts and earn good stable returns. I want you all to understand that the method that I'm going to teach you all is not something that will help you all earn flying returns. Such tricks are mere gambles. What I am about to teach you is something that will help you rationally analyze a company and help you create wealth in the longer run. So, let's get started. You must have seen a lot of people discussing about the best investment alternative. Some find government securities the best alternative, or some find tax-free securities the best one. However, most of we Indians like to invest our money into bonds or fixed deposits, where the risk of losing the capital is very low. These securities give you a return of around 8% per annum, which means if you invest rupees 1000 today, then every year you will get a return of rupees 80. Now think about this. We learned that the book value of a share is the value of the share that the shareholders would get even if the business were to shut down completely. Which means rupees 22 is the amount per share you're pretty much assured to get. Now compare this with the principal amount that you're paying for bonds. Rupees 1000 is the amount that you're pretty much assured to get at maturity. Hence, we can associate principal amount that you're paying for bonds with the company's book value per share. Similarly, we learned that return on equity is the rate at which the company is making profits using its assets. Hence, we can associate this with the rate of return that you would get on a bond. For now, for the sake of simplicity, sync this in your mind this way. Principal amount is equal to book value and rate of interest is equal to return on equity. Now, I want you to think. I want you to really put your mind into this. For 8% return, I am willing to pay 1 time the book value. Then, for 10%, I should be willing to pay a little extra. That is, 1.25 times the book value. For our company, SRC Private Limited, book value was rupees 22 and return on equity was 10%. And we already saw that for a 10% return, a person should be willing to pay 1.25 times its book value. Hence, for a company, the fair value translates to 1.25 times 22, that is rupees 27.5. Think of a situation now that you call your broker and ask the current market price of SRC, and he tells you that it is currently trading at rupees 16. This is the opportunity that you should grab. Remember, we have valued our share at 27.5 and currently it is trading at rupees 16. From rupees 16 to rupees 27.5, it's almost 60% return. However, this will take time. Let's assume it takes somewhere between 3 to 4 years for the share to reach 27. I would still be earning somewhere between 15% to 20% returns. Plus, I'll get dividends. And I do not have to pay any capital gain tax. But there's a catch. What's the guarantee that the return on equity remains stable at 10%? To be true, there's no guarantee. However, I can check the company's history. If I find that for the past 10 years, the company's return on equity is averaging around 10%, then I'm good to go. Now I wish to share 5 things with you. First, whatever we have learned is one of the ways in which you can invest in shares, but not the only way. There are different methods as well. 2. Prices of shares keep changing every second. Hence, it is completely possible that your share goes below your purchased value. You need to think long term. Don't let greed or fear take over you. 3. Start value investing. The share SRC Private Limited was actually a real life story of mine. I had bought NHPC in 2013 for rupees 16 and sold it at rupees 26 by this method. Intraday or short-term trading needs a lot of practice and time, but with value investing you can have peace of mind. 4. You need to keep learning. I learned this method from the articles of a prominent fundamental analyst of India, R. Balakrishnan. One of Balakrishnan's tips is that you should always buy when the market is beaten down. You'll get shares pretty cheap. Whenever you see markets falling, turn to this trick. You'll at least find a few shares worth investing. And the most important thing, if you like the videos, then do like, comment, share and subscribe. Until then, adios. Hasta la vista.